The following is paid programming.
It's time to talk taxes.
New friends, new opportunities, new partners. EGTax.
It's Ask the Tax Lady with Esther Gulius and EGTax on News Radio 930 WBEN. To reach Esther now, call 803-0930. Toll free at 1-800-616-9236. And cell calls are free at star 930. And now, live from the WBEN studios, it's Esther Gulius.
Hey, everybody, this is the Tax Lady, and this is our hour to talk taxes, and we're going to make you so smart, and it's our job to make sure that you know ahead of the curve. When everybody else is saying, gee, I wonder what happened, you'll say, I know what happened. So I'm Esther Gulius, the Tax Lady from EGTax, and I'm joined in studio with my buddy, Chris Fabian. Hey, Chris, how you doing?
Good, Esther. I forgot. Hello, Esther.
Hello, Christopher. And you guys are doing a party on the 4th, right?
We're doing a party on the 4th. Yes.
And I just want to wish everybody a happy 4th of July. I know Memorial Day honors the dead who gave their life for this country. The 4th of July is our Independence Day, and I hope it means a lot to everybody, because it certainly means a lot to me, and I know it does to you too, Chris, right?
Definitely. I mean, family members.
It isn't just about fireworks.
It's not. It's about this great country and the freedom we have.
That's right.
And, we take it for granted sometimes, and we got to...
I think we do take it for granted, that's for sure.
Yep.
So, so today, we usually come up with a topic to make you smarter than the average bear. And this week, we thought we'd talk about Social Security, how it's taxed, who gets it, should you take it now at age 62, should you wait till 66, should you wait for 70, how is it taxed, how much can you earn if you take it early, all those kind of things, all about pensions, can you take money out before you're 59 and a half, is it taxable, all those kind of things. And of course, we love it when you give us a call. Our phone number here in studio is 8030930, 8030930, star 930 on your cell phone, and you can text us at 716-8030930. So if you're out in your lawnmower with headsets on, you can text us if you, but make sure you don't crash into a tree.
And
right?
then come over to my house and cut my lawn.
Cut Chris's lawn. That's the only bad part about summer, is that the grass it's so beautiful and green, and the grass keeps going, right?
That's right. Even with no rain, the grass still grows.
That's for sure.
It's remarkable.
Okay, so let's. And by the way, wasn't there something you were going to tell everybody this week that just came down the pike?
There
was 23 million tax returns still not processed by the IRS.
Yep. 9 million of them are paper. I know
right.
They're really.
And
even
I just
payments.
had a gentleman text me the other day, and he said, I used a 1040 SR. I sent it in March, and I still don't have my refund. And when I go to the website, they have no information. That's because he sent it in as a paper return, and quite frankly, they're ignoring you when you send in a paper return. So I suggested that he come in, we can take that information, send it electronically, he'll have his refund in about 2 weeks, and that would be the easiest thing, and he'd know that they got it.
Right. I know we just did that for a client who was trying to get a mortgage, and they kept saying, we need a transcript of your return for proof of filing, and they wouldn't give him the mortgage, so he had to come in, and we did it electronically, and a week later we were able to call the IRS and got the transcript. Otherwise, he would have been SOL and never got the mortgage.
And with mortgage rates rising as quickly as they are, you want to make sure you get something locked and loaded.
Yep.
Okay, so all right, so let's.
Hello.
So that was.
I'm saying
was there
hi
anything?
to the dog.
Pardon me.
Tiff's here, and
I know.
she was
Hey,
saying
Tiff,
hi to Beasley.
You're taking care of the puppy?
I can't hear Esther.
Oh yeah, she can't hear you right now.
Oh well,
but
that's your dog just got herself spayed, so
that's why she's here.
She's there with you.
Oh.
And
Yes.
is she sad?
Oh, she's a little bit happy. Mommy came in the room.
I got it.
Oh, that's good.
So
all right, so let's talk about retirement and how it's taxed, and first of all, if you're retired on a public pension, what does that mean?
Well, good news if you're a New York State resident. I mean, that's all tax-free.
But what is a public pension?
You worked for the city, county,
The
the
municipality.
municipality, the state, the federal government, the post office, the railroad, the
The
military, the
right,
IRS. So
Any governmental
Office.
agency,
Yep.
as small as a little municipality, all the way to the federal government. If your pension was funded through those sources, then on New York State, regardless of your age, it's completely tax-free, correct?
correct.
On the state.
Right, on the state return. Now, on the flip side, if you work for a private employer, in other words, not a public one, then you would have a tax-free benefit on the state of New York as well, but you have to reach age 59 and a half, right?
Correct.
Right, and then you get the first $20,000.
$20,000
Just you or your spouse as well?
Your spouse also gets another $20,000 exclusion.
on their pension
Right.
or IRA.
So if you're filing a joint return, your pensions are, and you're on a non-public pension, your pension would be up to $20,000, and that includes IRAs, and your spouse's pension up to $20,000, and that includes IRAs. So collectively, you might have as much as $40,000 as a subtraction on the state of New York for a tax-free pension, right?
Right.
That's right. Yeah, and then if you inherit somebody's pension and you have to do your minimum distribution for their pension, if that person who passed away was over the age of 59 and a half, dependent on how many beneficiaries were, you get to exclude that 20,000 spread out over the
Well, let's say,
beneficiaries.
so that same 20,000 is still a subtraction on the state of New York. And if there's two beneficiaries and they took out $20,000, 10,000 would be tax-free to one beneficiary, 10,000 to the other
Correct.
on the New York return.
That's right. That's
Right?
right. Yep. And that's missed frequently, and so you just want to, know what you know and make sure you go to the expert.
Right.
And
And
that's-
so if you're hearing something for the first time and you say, gee, I've been taxing myself on my pension on New York State, you got money coming back.
You sure do.
Right?
Yep.
Now, if you're under the age of 59 and a half, then we know that if you take money out of your pension or your IRA or annuity, then there's a penalty that they charge you, correct?
Most of the time, there are exceptions.
I know, and that's what I want to talk about.
I know. I was setting you up.
You would be, I'm not saying eligible, but you would be, at first blush, you would be looking at a 10% penalty plus regular taxes. But there are exceptions for taking the money out under age 59 and a half, and that would be, one of them might be what, Chris?
When you're under 59 and a half, if you do systematic withdrawals at age 55,
Right,
you're disabled.
right.
Medical expenses that exceed the threshold for itemized deductions. Health
Which means that it's a lot of money.
Yep, you have a ton of medical bills. Health insurance for the unemployed. You can take money out of your IRA for education.
Right.
Notice IRA, not either or, just
That's
your
right.
IRA.
And so if you have a pension and you took it out to fund your kids' education, you'd still pay the 10% penalty. But if you are if it's out of your IRA, then and you're using it for your funding your kids' education, then it doesn't make you pay a 10% penalty. So a little planning would be, if you have your money in a pension plan, to roll it over into an IRA so that the money that you take out would then qualify for the non-penalty.
Right. And the same goes for taking the first $10,000 for a down payment on a home for a first-time home buyer credit.
Right. Or and then the last one would be if the good old IRS is levying you.
Right.
Right. Yep.
You can also take money out of your pension without the 10% penalty. So that saves you a ton of money.
Which,
right?
Going back to the previous two, before that one, I'm surprised nobody's taken that to tax court yet. That it's an IRA only for an education and the first-time homebuyer credit, because somebody could roll the money over from their 401k into an IRA and then take it out and avoid the penalty.
Right. Well, unfortunately, that's how a lot of tax law is. If you don't know, you don't take it. I mean, that's why knowing the tax law is so important.
Correct.
Right?
Yes.
Yeah.
Yep.
So, okay, why don't we take a short break? I'm Esther Gillius, the tax lady, 8030930, 8030930, star 930 on a cell phone. You can text us at 716-8030930. We're going to take a short break. We're going to be back with all about your Social Security on the other side.
We are family. I got all my sisters with me.
Well, happy 4th of July, family. I'm Esther Gillius, the tax lady from EGTax, and I'm joined in studio with Tiffany Fabian, Christopher Fabian, and you're going to have a big shindig on the 4th, right, Tiff?
Yeah, we are, just to celebrate the birth of our country, and very patriotic, and above all, we're going to be with our family, and
that's the best.
That's the best.
That's the best.
Definitely.
Okay, so why don't we have a text? Why don't we talk about the text?
If someone is on Social Security and doesn't need to file a tax return, what happens with that new New York State property tax credit this year? They base it on your 2020 tax return income. So if you don't have to file a return and they don't see your income, how will you get the credit?
Well, I think this is a really important thing that people have to understand. With all these credits coming down the pike, and everybody scrambling around putting their stuff together to get these credits, and I think just do a return. I mean, wouldn't you guys agree with that? It's not going to just do a return, get it in line. There may be that you can apply for it after the fact and show you didn't have to file, but just do the tax return.
Right. How about they may have missed out on $350
right.
as well as this check that was the property rebate that was just issued, because New York State in 2021 just came up with that new property credit for people who pay more than 6% of their income to property taxes, which is cool. And
unless you file your return, you don't get the money.
Right. So I would tell this texter, I would come in and file, because you could be missing out on some money.
Right. I mean, or, do your own New York return. But if you do it incorrectly, then you could miss that New York State property tax credit, that brand new property tax credit for people that are paying school taxes over 6% of their adjusted gross income. Well, if you have very low adjusted gross income, you would probably qualify. And so you got this money coming. But if you don't file, being penny wise and pound foolish, right?
Yep. That's
okay.
for sure.
I'm Esther Gillies, the tax lady, 8030930, 8030930, star 930 on a cell phone. Again, our text number is 716-8030930. All right, so let's talk about, a lot of people don't know if their Social Security is taxable. They don't understand how it's taxed. Many people think it isn't taxed, and so I thought it would be interesting to clear this up. So when is Social Security taxable when you're single?
Well, that's that crazy A squared plus B squared equals C squared formula. You take half of your Social Security and you add it to all your other income, including all your Social Security and your tax-exempt interest as well. And if that income combined with half your Social Security is over $25,000, then your Social Security starts to become taxable.
Right,
all
half
the way
taxable.
Yep.
The excess over that
the
is
excess
half taxable.
over, all the way up to 85% of your Social Security. So,
right. So let me give you a little, and if you're married filing a joint return, that number is $32,000.
correct.
Right. Notice, if it was two singles in the house, it'd be 25, and 25 is just 50 as a floor. And if you're married filing a joint return, it's 32.
Yeah, and that's
The
why
marriage penalty.
That's
right?
why we talk about when seniors gamble, it just increases
Right,
that
but
opportunity.
let me give you an example here so that people, because many people are not going to be paying any taxes at all, they let their IRAs sit in that account, in their accounts, waiting for the required minimum distribution before they take it out, when they should be taking it out now. But let me show you here how it happens. So let's say we got a married couple and they're getting Social Security collectively of about $40,000. And they have an investment income of $8,000, and one of them's got a little job of $3,000. How much of their Social Security is going to be taxed, Chris or Tiff?
0.
Yeah.
Right, 0. Because half of the 40 is 20. When the 20's added to the 8 investment income and the $3,000 wages, that comes up to $31,000. Until it gets to 32, it's not taxable. So they're not going to pay any income taxes on their Social Security. Are they going to pay any taxes on their investments or their
No.
wages?
No.
Yeah.
No,
and-
so because that's only $11,000, right?
Yeah, and what's really important is when you're in this situation, say this person had $5,000 before it was taxed, they should take maybe money out of their IRAs or because
Right.
they get all that extra.
And that's
money.
exactly right. But in this situation, because one of the taxpayers were working, they get an earned income credit. So not only do they not pay taxes, the federal government pays them.
Very
So when
cool.
you're sitting around saying, well, I don't have to file, well, you don't have to, but maybe you need to.
Yeah, that's a new change in the law, which is very exciting.
That's correct.
You know,
So
but-
I just thought it'd be interesting for people to see your Social Security doesn't get taxed until half of it added to your other forms of taxable income exceeds either $25,000 if you're single, $32,000 filing a joint return. Then the excess over that is only half taxable. So when you're basically living on your investments and your Social Security, you're not going to pay taxes for all intents and purposes, which brings you to what you were talking about, Tiff. So you're sitting around there with maybe $10,000 before you pay taxes. Take it out of your IRA
Yep.
Right,
Most
like-
definitely.
because then it'll be tax-free.
Right, like in this example, if they were to take $5,000 out of their IRA, and so okay, oh my God, that's going to mean $2,000 of their Social Security counts as income, but they're only at $18,000 of
So they're
tax.
still not going to pay taxes.
They're still not going to be pay tax because their standard deduction is about $28,000.
Right. So
They
they can take $10,000 out of their IRA
pretty much
for
yep.
free.
Yep.
And so this is something you need. We highly recommend that you give your accountant or give us a call so we can tell you how much you can take out of your IRA tax-free before you'd have to pay taxes. Many people go, oh, I want to put money in a Roth so I don't have to pay taxes when I take it out. If you take a look at what's available to you right now without a Roth, you're going to find that you can take out much of, if not all, of your IRAs and pensions tax-free as well,
That's right.
because rather than waiting for the required minimum distribution.
Yep. Take
Right?
it. Yes, and this way then it lowers your RMD.
All right. I'm Esther Gullius, the tax lady from EGTax, 8030930, 8030930, star 930 on a cell phone. Whoever wants to invite me over for hot dogs, I love hot dogs. You know, and I think that's one of the great things about summer. But we got Kevin from Pendleton that's been waiting. Hey, Kev.
Hey, how you doing, folks?
How are you, sir?
Good. Better fine. Now, I heard what you were saying, what folks were saying about what you could take out of your IRA. And I think I heard you say that you could use it for part of it for your kids' education.
Yes.
Not the whole thing, just part of it.
Well, no, if you're taking money out of the penalty, there is no penalty if you're under the age of 59 and a half if you take the money out of your IRA to pay for education.
Oh, wait, so it's not only for the kid. Like if you have a deadbeat kid, but you want to do something for yourself at the later stage. You know?
Yeah,
Yep.
absolutely. If you're
For
using
you
it
or
for
your kid.
education, then you're not going to pay a penalty. It's not that it's not taxable, but you aren't going to pay the additional 10% penalty.
Oh, okay. So you said that additional 10% penalty.
Yeah, it's always going to be
saves you.
taxed. It's just the penalty that's waived.
Right.
Oh, right.
And of course, if you're over the age of 59 and a half, there's no penalty at all. And on the state of New York, the first $20,000 would be tax-free, would be not taxable. So
Oh, okay. So if you're over the age of 59, no penalty, no tax?
no tax no tax up to 20,000 on the state,
$1,000, right? Up to 20,000.
up to 20.
Good to know that. Great. Hey, you guys have a happy.
Happy 4th.
But you
Kevin,
pointed out a good point, Kevin, that it's not just for your kids, but it could also be for you, too. Good point.
with the deadbeat kids, right?
Yes. Happy 4th, Kev.
All right. So the next thing I wanted to bring up is when should you collect Social Security? This is
That's a
this is another
huge debate.
conundrum. Should I collect Social Security at 62, 66 at full retirement, or should I wait till 70? And there are pros and cons to everything. Obviously, if you're working, because you would have to pay back $1 for every $2 that you have received in Social Security benefits if your wages exceed $19,560. Now, bear in mind, that's a lot of money.
That is.
I mean, so if you decided in September that you would like to retire, if your wages, you're not going to have wages over 19,560 in that calendar year, but they let you just use the 19,560 divided by 12 or 1630 per month. So if you had made $50,000 up till September and then you retire, you can still make $1,630 per month for the rest of the year and not have to pay back the dollar for every $2 you earn.
Right. I mean, you got to use the tools to your advantage, you know. And I probably after the news, I know we're going to talk about, you know, to take
We'll
it
give some
early or
examples,
not,
but just to kind of think about it, because we're going to talk about what happens at 62, what happens at 66, and what happens if you wait to 70. And we're going to look at the pros and cons to help you make that decision, because a lot of people are thinking of retiring. We're going to take a short break for the news, and we'll be back on the other
We'll
side
talk
with
to
your
Robert
questions.
and Don.
We are family. I got all my
Hey, happy 4th of July. This is the tax lady, Esther Gulias from EGTax, and we're talking about Social Security today, but you can call us with any of your particular problems that you might be having. But, you know, just like Tiff said in the commercial there, if you're getting letters, don't wait. Call us. My girlfriend the other day called and said, Esther, I got a letter because they're charging me $12,000 because she had done a charitable rollover. And the IRS thought she didn't include her pension. So we got the 1099 from the broker, a letter that said she did a direct rollover, and so she went away to North Carolina in peace. So we love to help you.
definitely.
Right? Let's go back to the phones. We got Don. Hey, Don, how can we help you?
Hey, how you doing today?
Good. Happy 4th.
You too. Just a quick question. I retired from the military, so I have a pension. I also have a disability pension from the VA, and I'm looking at taking my Social Security at 62.
Okay.
How will it affect my taxes?
Okay, so first of all, you have to take one bite at a time. Your VA pension is not going to be taxable.
Right.
Okay. How much are you getting from your regular pension?
Oh, about 45,000, but I don't
Okay.
have to pay state taxes on that.
All right. So you don't have to pay New York State taxes, but at 45,000, are you single or married?
Married.
Okay. Does your wife have income?
No.
Okay. Is she going to collect Social Security as well?
Yeah, probably like 3 years or so.
Okay, so because right off the bat, without adding any of your Social Security to this number, we already know that you exceed 32,000. So you are going, whatever Social Security you get is going to be at least partially taxable, right, Chris, Tiff?
Yep.
Yep.
Partially?
Well, how much are you going to be getting?
I believe it's only like 1,400 because I got disabled when I was 45.
Okay, so you have 16,800
Yep.
plus the 40, so that would be 8,400 plus the 45,000. So it's 53,400, which is
21,400.
32, which is 21,000 over. So 10,500 of it's going to be taxed on top of the 45,000. So you will definitely pay taxes on the money.
Only on the
Probably at
federal.
about 20%.
Not on the state, which is
Not on
nice.
the state.
Okay, so be at 20% rate?
Right. So it's going to cost you about $2,100 on your Social Security in taxes.
That's what I wanted to know.
Okay. But if you want a specific, give us a call. We're happy to run the numbers for you.
Thank you for your service.
All right. Thanks a lot, Don.
Thank Thank you.
Uh-huh. I'm Esther Gullius, the tax lady from EGTax, 8030930, 8030930, star 930 on his cell phone. So you see what happened. He's got the $45,000 pension. Can't do anything with that. But his Social Security is 16.8. Half of it gets added to the 45,000. Then that's subtracted from 32, and the answer, half of that, is what's going to be taxable on his federal return, up to 85%.
Right,
Right, guys?
Correct.
Okay.
Correct.
So why don't we go to Robert?
Robert.
Mike. Okay, Mike. Okay, Mike. Hey, Mike.
Hello.
How are you?
In the Buffalo News, on the front page on June 23rd, there's an article, Higgins Jacobs aren't sold on plan for gas tax holiday. Now, Brian Higgins said he was concerned that the gas tax holiday could reduce federal infrastructure projects. As an alternative, he proposed a tax credit whereby consumers would be given an advance on the tax refunds they would receive next year to get cash in their hands now. But when the word advance, you're not getting any money other than what is your own, right? You're not going to get more money.
Right, and that's all the things at the beginning of the show we were talking about, people that aren't filing returns because they don't think they need to. With the present disposition of what's going on in the government, and Tiff and Chris, give me your 2 cents on it, do the return, because then they have you in the system, and do it electronically as well. But then they have you in the system. If somebody is doing an advance on next year, unless they come up with a plan, like they're going to send you money, they're going to give you a voucher, it's just not in the cards. It would be next year. So they'd have to come up with a plan how they were going to fund that.
But that's very confusing.
Well, everything.
Hey, something where you're just
Mike, isn't it all confusing? I mean, until you find out what they're going to do, you just can't even hazard a guess. So, I mean, obviously the gas taxes and the high cost of gasoline is a horrible thing. For those people that have to drive for a living, they are giving up a lot of their expendable income to pay the gasoline. So hopefully they're going to, and then the more people press, the better it is, because they're elected officials, so make yourself known.
Well, the whole thing is, it sounds like a political move before the election, because the taxes come due after the election, right?
Yeah, elections in November.
Right.
But the thing is, too, like you said, if it's an advance on your taxes, if you owe money, you're going to owe more money. Right. And people aren't going to be expecting that one. So that's not a good idea.
No, how's it going to help people with inflation? I mean, you're just going to get your own money earlier.
Yep.
Right, absolutely. And just it means that you'll end up owing more next year, like Chris said, possibly. So you just have to let yourself be known and remember this in November.
Yeah, because they're not really giving me anything then.
Well, Mike, they're not giving you anything anyway, right?
Okay, thank you.
All right, thank you. I'm Esther Gullius, the tax lady from EGTax, 8030930, 8030930, star 930 on a cell phone. And you can email us at 716, not email, text us, 716-8030930. And who do we have next, Jeff?
There's a really long text. Maybe Chris will read it.
I'll read it. Here's my question. I am recently retired Erie County civil servant that contributed to a deferred comp program. I'm 56 years old, and I was told that if I withdrew less than $20,000 spread over 12 months, I will be taxed 20%. However, I will be reimbursed next year during the tax deadline, since this is my only income, except for a pension that is only taxed by the federal government. Am I incurring a penalty, or am I being overtaxed in the front end, and will it be corrected once I file taxes on the back end?
Do you understand what the question is?
Well, his pension is going to be tax-free
Right,
on the state. His deferred comp
is going to be taxable over $20,000.
Well, no, he's 56.
Oh, then
So
he's going to pay taxes on the whole thing.
on New York, both federal and state.
Because he's not over the age of 59 and a half.
Right. So
So once he's 59 and a half, That's when I'd suggest him take out his deferred comp if he's concerned about paying the taxes to New York State. But I think more than anything, don't you think he should call and we'll work out all the numbers so he knows exactly how much he's going to be paying? For instance, let's say that his tax liabilities on the state of New York is only $1,500. Well, for $1,500, he might say it's worth it.
Right. But, if he's taking $20,000 out now, unless it's systematic payments like we said in the beginning, he's going to get hit with the 10% penalty.
On the federal
right. Side,
and
too.
And on the state of New York, he's going to pay taxes. But
yeah.
that's why it's really important. Is he retired on a disability?
Right.
So we have to find out if he comes into one of those exceptions. I would suggest he call. There's no charge. It's complimentary. Happy to help.
Definitely.
Yeah, there was somebody who was in the office on Friday, and their consultation was they have $100,000 in the 401k, and the 401k is doing so bad he wanted to take it out and use
that's
it
be careful of that.
Yeah.
You're absolutely right about being concerned about your pension plans dropping, but taking all the money out is shooting yourself in the foot because
he would have paid
now you're going to pay
35%
taxes
in
on the
taxes.
decrease
Yep,
because all of these weren't taxed before. So what you want to do is move it over to something safe.
That's what I
And if you move it
advised.
over to something safe, it's not going to get much. You're not going to get a lot of interest, maybe 3-4%, but the volatility won't be there.
Yeah, I
And
said, look at him. It grew $28,000-$30,000, and so you lost 19. You're still ahead. I go, just cut your losses, right?
Right. Well, and again, if you can put it into something safe, if you're that worried
what we
about
told
it, you don't want to pay another 20 or 30% in taxes on it.
Right. That's what we advised him.
Right.
But people are panicking because of what's going on in the
Well,
market.
and you can't blame them.
Nope, you can't. You can't.
As a matter of fact, there's an annuity that I am aware of that's paying 9.5% interest right now.
Holy cow.
And interest rates are going up, so that's
How long do you have to leave it in there for?
1 year.
Oh, wow.
So
Wow. There's
So,
Bill-
and if
Bill-
anybody wants to know about that, but it is an FDIC insured. It's a corporate bond.
Okay.
You want Bill from Williamsville?
Yeah, let's talk to Bill.
Bill from Williamsville.
Hi there.
Hey, Bill, are you out there cooking hot dogs today?
That will be tomorrow. Today's yard work.
Oh, that's good because you
Getting
got to make
ready.
it look good before everybody comes over, right?
That's right.
And then dinner tomorrow's what time?
You guys are welcome. Yeah.
Oh, you're so sweet. What can we help you with?
All right. So I'm 59. I have a SEP account,
Okay.
which only has just a little bit of money in it. Had a small home business in the past. And anyways, I previously had tried to transfer this into a Fidelity 401k, and that didn't meet the rules for transfer. So it's just kind of sitting out there.
But you can roll it over into an IRA.
I could. What I was wondering is, shortly I'll be 59 and a half.
Mm-hmm.
I'm wondering if the rules would permit me to take that out without penalty at that point. And what's your advice?
Well, how much are we talking about?
Only $4,000.
Okay, so yes, at 59 and a half, you can take the money out. You're not going to pay any taxes, any penalty. You're going to pay income taxes on the federal. On the state of New York, if this is your only pension that you're taking the money out of, it's going to be tax-free on the state of New York. So if you're retired at that point in time, or maybe in the 20% bracket, you'd only pay $800 in taxes.
All right. So I am still working, and I'm considering this for purposes of just catching up on credit card debt and things like that.
Right, which is a lot better than, thinking that you might pay $800 in taxes and you got $3,200 liquid and you can pay off 25% credit cards. That makes a lot of sense.
Okay.
Okay?
Great. Well,
Hey,
thank
happy 4th.
Great question.
you too.
All right. So, let's talk about when you should start collecting Social Security, because a lot of people, obviously we talked about if it's going to be taxable before, but here's another thing. Should you start collecting at 62? All right. And so at 62, there's they actually reduce what benefit you would have gotten at age 66, normal retirement age. And if you waited till 70, you get 8% a year kicker if you wait. And so a lot of people think, well, that's 32% on this money. That sounds really great. Well, let's put a pencil to the problem here. So let's say that you're 62 and you're going to get a benefit of $18.75 a month in Social Security. Okay, that means that you get $22,500 a year, but if you waited 8 years until you were 70 to collect, you would be leaving $180,000 on the table.
Wow.
Now, if you die anywhere between now and the time that you come out ahead on that $180,000, they're not going to come up to your spouse and say, "Oh, by the way, dear, the Social Security owes you some money." So I just want to make that clear. So if you wait till age 70, you would get a benefit of $3,300 a month or $39,600, and you think, "Wow, that's great." But you actually, with that increase of $17,100 a year, it takes 11 years to be flat even. So basically, at age 81, that's when you break even.
And then
By 81, 50% of the population is gone. So, and then of course at 81, what are you going to be doing? You're not going to be going on too many vacations at 81, one would assume. So that's what I wanted to bring up, is for people to understand that when you don't take the Social Security, you don't ever get a chance to get it back in a lump sum again. So until you have to age out of the problem.
Right. Well,
Okay.
Yep. Why don't we take a fast break?
All right,
And
we're
then
going to take a
talk to
short
Jim
break.
on
I'm
the
Esther
other
Gullius, the
side.
tax lady, 8030930, 8030930, star 930 on a cell phone. We'll see you on the other side.
We are family. I got
Hey, happy 4th of July. This is the tax lady, Esther Gullius from EGTax. We love helping you. You can tell we love you guys. Remember, if you're thinking of taking early retirement, you don't have to pay back $1 for every $2 if your wages stay under $19,560, and there's this kind of a phase in the year that you collect, that you start 62, they don't kind of penalize you for your other wages. So there's that. And the other thing is, if you're divorced from somebody that you'd been married to for at least 10 years and they were gainfully employed and paying into Social Security, you're entitled to half of their Social Security as long as you haven't remarried. So a lot of people, I don't think, know that, so if your former spouse that you've been divorced for some time, and they had worked more than 10 years and you were married to them for 10 years, you can be eligible to collect half of their Social Security. And of course, all non-working spouses are entitled to up to 50% of their working spouse's Social Security, and it doesn't affect the working spouse's benefits. So,
Yep.
and I had a couple years ago, and I said to her, "Well, where's your Social Security statement?" And she said, "I don't get it. My husband gets it." And I said, "Well, you get half of his." And she says, "No, because why would we do that? Then he loses half of his money." And I said, "No, he gets all of his money, and you get half of his in addition to."
Yep.
So that was a happy day.
Yeah.
There's 3 callers now.
That's what I love about what we do.
love helping
it's just
people.
remarkable how you can just say to somebody, "Oh, by the way, I just got you an extra $150,000 for your life," or something. Okay, why don't we go back to the phones? We're going to go to Jim first.
Jim first.
Jim first.
Oh, Esther, a happy Independence Day. I think it's a little more specific than saying July 4th.
You're right. Well, how can we help you, sir?
Okay. I'm going to go back to the income that was earned in 2020.
Okay.
Because, I'm one of the paper filers. Okay. Now, because of the delay, when the IRS got their act together and finally sent out the refund, they had given a 6% increase for that delay. Is that correct?
You mean they're paying you interest on the money? Yes.
Yes, the interest on the money.
Mm-hmm.
You do that this year.
If the Internal Revenue Service is late in processing, until they send you the money, they will add interest to that refund.
Right.
No matter what year it is.
Because at the beginning of your show, somebody had called in about they had sent it in March. Now, the thing is back in 2020, when I had mailed it in 2021 for the income of 2020, they didn't send my refund, until August.
Right. I'm sure that you had some interest that was tacked on.
Right, yeah, it wasn't that much, but, my refund was small anyway.
Mm-hmm.
What I'm trying to say is if they're going to wait, they may have to wait till August to get their act together.
Well, I mean, you just don't know. They're $21 million, 21 million returns behind as of last week. So,
Yeah, okay.
yeah, it's a big number. So that's why, initially when electronic filing came out, I was very skeptical because I'm an old dog and old dogs don't like to do new tricks. But I will tell you, I'm a believer. Electronics is the way to go. Everything else is electronic, your telephone bill, your electric bill, your credit cards. So anyway, if we can help, but thank you for bringing that up.
Can I ask you one more question?
Of course.
Is there any update on Kathy Hochul sending out those rebate checks to home?
Well, they should have started in June, and they're saying by September they should be out.
Yeah,
Right, Chris?
what I read was that their initial shipment of all the checks would be out by the first week of July. Then for the towns that were behind in reporting, those checks will be issued before the property taxes are due in October. So you may have to wait till September if you didn't get it yet.
Well,
But I think part of the problem is his return was paper, and they're looking at the 2020 return, right?
Right, that's correct. And
I mean, that could hold it up as well.
Right, I understand. Well,
So and that to me is so important. When you already had a problem and everybody's saying don't do paper, and you keep doing paper, you're not helping yourself.
Yeah, that's true.
That's what I would tell my kids. So, all right.
But I mean-
Hey, thank you. Happy Independence Day.
Right.
Okay,
And then
we
we're going to
got
go
Art.
to Tim or Art.
We're going to go to Art.
Hey, Art.
Art?
How are you, sir?
Good, thank you. Thank you for taking my call, ladies.
Yes,
I got
sir.
a question about moving some traditional IRA to a Roth IRA.
Okay. Why would you do that?
Why? Because I'd like to have some money left over for our children.
Okay, but if we can show you that not that it isn't a good thing to do, maybe, but in many situations, if not most situations, it doesn't make any sense because you're paying the taxes up front that you may never have to pay. You may not ever have to pay when you retire. When you retire, what do you think your monthly pension is going to be?
We are retired. Both my wife and I are retired.
So what's
how
your
much
income now?
is your monthly?
We're both collecting Social Security right now.
That's all, right?
No, we have capital gains and we also have a pension.
And
All right.
much?
How big is your pension?
Pension is $20,000 a year.
Okay, so I'm assuming that the two of you then don't pay any taxes at all.
No, actually we did because
Not much.
Well, I would.
Capital gains.
Yeah, I would almost say, Art, you need to call us on Monday.
Right.
We
Well,
could
first of
work
all, we're
up-
running out of time, but
Yeah.
but you're in a very low tax bracket. If you were to roll over $200,000, for instance, it would probably cost you $40,000 or $50,000 in taxes up front. But let's look at it from another point of view. It's always good to have a devil's advocate and give you some information. There's no charge, and we'd love to help you.
Okay.
Okay.
And
you
the
c-
phone number is on Monday or Tuesday. Call 632-7886. Again, 632-7886. You might be surprised. It doesn't cost anything, and you might be surprised about
Yep,
converting money to a
because I'm
Roth.
going to tell you, losing 50, 60. I had one client that rolled over a mess of money. When I got done with him, he owed like $350,000 in taxes. I thought he and his wife were going to fall dead on the floor.
Yeah,
They didn't
well-
realize how much it costs to do a rollover from a traditional to a Roth if you got all kinds of money. And if you'll never make that, probably never make it up. It'll put you in a
And
gigantic tax bracket.
Not to mention with Art, Bear probably very little of his Social Security counts as income.
Right.
If he converts over, he's going to add his Social Security as income
Absolutely.
as well. So
In
he's
the
going
year
to be
that he
double
takes the
taxed.
distribution, right.
Yep. And I
Okay,
know
we got Nick.
We got
Yep.
Nick.
Hurry up, Nick. How can we help you, sir?
Yes, I know we're running out of time, but I have a very important question for Christopher Fabian.
Well, first, Nick, how was your daughter's wedding?
Well, thank you for asking. It was very expensive. That's time. For those of you out there, the fire hall is the way to go. So we're running out of time. So I was going to ask a Social Security question. I'll tell you what I'll do, Christopher. I'll call you this week sometime. Just
Perfect.
For questions.
Yep.
Lastly, I do have a very, very important question. On my invitation to your party, I don't see the time. What time would you like me and my family there?
2 o'clock.
That's great.
And bring your bathing suits, right?
Yes, bring my bathing suits. And, of course, the kids want to bring the sleeping bags because we're staying overnight. So I will catch you during the week. When
That's fine.
Time, okay?
All right. Hey, thanks for calling.
There's a text. It says your Social Security break, even at about 80, is right. But if you have other sources of income before you're 80, that needs to be part of the equation as well.
But you're paying.
No.
It's missing money. He's missing the point.
No. Because I'm not talking about the taxes. I'm talking about the money you left at Social Security.
Yep.
It has nothing to do with that. You don't break even till you're 81.
And then another
So
text.
at 81, you and your spouse can say, wow, we now broke even.
Okay,
And
there's
it may
another-
work for
there's
you,
another
but
text.
for a lot of people, it doesn't work.
And somebody texted me on my phone, can you please tell me about that 9% annuity?
I'll have it because they just called me the other day and said, would I be interested? And I didn't write down the name of the company, and it's my friend's company. So I will give it to everybody on Tuesday. We'll call the office.
If I was married for 5 years and my wife passed away, can I collect under her name and then change to my name at 70? She was 7 years younger than me.
Well, you had to be with them for at least 10 years.
Even for
in order to qualify for their Social Security, and they would take you whichever is better. Yeah. Okay, so I'm Esther Gullius, the tax lady. I'm going to tell you, everybody, I love the United States. We are so blessed in this country. We have wonderful people. I just wish we all got along. Thankful for everything. Thankful for you listening. Have a wonderful Independence Day, 4th of July. And thank you for listening. I'm Esther Gullius, the tax lady, with Christopher Fabian, Tiffany Fabian. Call us at 632-7886. We want to help, and there's no strings attached. Thanks for listening. Bye-bye.